Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Phil Mackintosh, chief economist at Nasdaq. We're going to take a look at labor market and determine if the strength is behind us at this point. Phil, it's great to see you as always. And we had a couple of big data points over the past couple of weeks, jobs and CPI this morning, and it seems as if the market was kind of like, meh.
For the CPI?
Yeah,
and there was a big number. I mean, we've been waiting for the CPI to come down for a long time, and today it came from 6% to 5%, which sounds like the drop that should be getting people excited, but actually the market's kind of sideways, bond markets and equity markets. And I think part of the reason is the underlying core inflation, which takes away food and energy, has actually ticked up a little tiny bit, and it's kind of sticky. It's much less, it's dropping much less quickly than the headline rate.
If we take a look at labor demand, the data suggests that it's past its peak at this point.
It sure does. I mean, it really doesn't matter which way you cut it now. If we look at the hours worked, they're starting to fall. If we look at the wages, they're rising, but much less quickly. You're starting to see a lot of layoffs. And actually, when you look at some of the layoffs data, you're starting to see companies laying off because they're slowing down in their production side, not because they're cost cutting. So you're really starting to see a lot of signals that the economy is past its peak, and the labour market is much softer now than it was a year ago too.
I thought your team pulled up some interesting data that could suggest there is some limit to the downside, however.
Yeah, so I mean, there's a risk if we start to see an uptick in unemployment. If you look historically, once unemployment starts to go up, you seem to get workers get nervous, so they spend less, which means companies earn less, which means they lay off more people, and then unemployment gets worse. And you have this feedback loop, which makes unemployment get quite a lot worse, the economy slow down really quickly, and you have a recession. This time around, the Fed even forecasts that we're going to have more than a 0.5% increase in unemployment. One of the things that might stop that from getting worse is all these retirees that we've been talking about during COVID, they're not coming back yet. So there's millions of people that look like they've left the workforce for good. And also immigration was slowed down in the last 3 or 4 years, and it hasn't picked up either. So there's actually a lot of missing people in the workforce, which might mean that even with less jobs, we still have pretty close to full employment.
Yeah, well, it's interesting because when you think about what the market prices in and how far ahead it's looking and so forth, to your point earlier, when you get that print where you're starting to see the data align with what the Fed is trying to achieve, you would have thought the markets would have taken off. So makes you wonder, okay, is this priced in? Is everyone expecting this to happen? You know, it's looking at the next 6 to 9 months?
Yeah, usually when the market does nothing, it's because the market has priced in exactly what the surprise seems to be. And it's good news, really, because we could see a slowdown that's not a complete stop for the economy, and that's relatively good for markets, it's relatively good for jobs, it should be good for the consumer too.
All right. Appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.